Hello, I'm Hunsley of Livewire Markets and welcome to The Pitch. Joining us now is Colin Mackay of Cromwell Property Group. Colin, if there is one thing that COVID has changed fundamentally, it's probably the way we all work, right? And just as importantly, where we work. Is the death of the traditional office real?
Look, short answer, no. But the headline, grabs plenty of attention. But in reality, it doesn't really paint a full picture of what's happening on the ground. We have seen, a pullback in demand, and that's seen office vacancy rates become elevated. But the market will resolve that over time. We'll see reduced levels of new supply, and Australia continues to have really strong population growth, which is a fillip for demand going forward. I think it's important to note as well, people were calling the death of retail 6 years ago, and we've still got shopping centres. That obviously hasn't happened. What has happened is there's been a greater bifurcation in performance between the top quartile performers and the bottom quartile performers. And there's been changes in the way shopping centres are managed. And so I think we'll see similar trends play out in the office market. The assets that tick all the boxes will continue to do quite well. And they'll outperform the assets that are missing a piece of the puzzle.
Okay, so what has brought about those changes we've seen in recent years?
Well, like you said, the big driver has been greater prevalence of working from home. It existed before the pandemic, but not to the extent it exists now. And I don't think we're going to go back to 5 days a week in the office. Having greater flexibility, it's good from a diversity and inclusion perspective. We're seeing record levels of labour force participation. And it also improves employee engagement, employee retention, and that can be good for businesses too. And ultimately, I think the key is balance, right? And for most roles and most organisations, that's a mixture of some time in the office and some time not in the office.
Yeah. Okay, so that trend that you referred to then, is it impacting all parts of the market in the same way, or are there differences?
We're definitely seeing differences across geography, industries, and occupier types. So on the geography side of things, if you look at a market like the US, which is actually where a lot of the negativity is originating, office utilisation is about 55% of pre-COVID levels. You look at Australia, we're at about 75%. So you're already dealing with a very different kind of demand profile. And even within Australia, a market like Perth is kind of 90% of pre-COVID levels, and a market like Melbourne, which had a more intense pandemic experience, that office utilisation is lower. And from an industry perspective, we've certainly seen professional and financial services kind of pull back their office footprint a bit. But we've seen the public sector, we've seen blue-collar industries actually expanding their footprint. And probably the biggest trend we've been seeing is on the occupier side of things, and that's much stronger demand from smaller occupiers. And what I mean by smaller occupiers is kind of that less than 1,000 square metres. And I think one of the big drivers of that is the nature of work. So smaller firms tend to be a little bit more dynamic, and they're doing tasks which favour that face-to-face interaction. And you contrast that with a larger occupier. They might have a big back office function, a lot of employees doing maybe focused tasks individually, and they don't necessarily have to happen in the office environment. So that difference in the nature of work is a big driver. And I'd say the other main one is simply headcount growth. We saw much stronger jobs growth across smaller firms than larger firms over the last 3 years or so.
Okay, so those are the opportunities across large firms and small firms. You were talking just briefly there about smaller occupiers. What do you find are the risks involved in catering to those smaller occupiers?
Yeah, they're often viewed as riskier, but I think it's a bit of a misnomer. The common detractor or disadvantage that's commonly stated is that they're more likely to go bankrupt. They're going to stop paying the rent. But if you look at the data, it's really not the case. You look at the survival rates, 4-year survival rates of firms with 200 or more employees, it's practically identical to the survival rate of firms with 20 to 200 employees. So I think when you're dealing with small occupiers, you're actually able to manage risk a little bit better. They provide you more diversification. They span every industry. They're not skewed towards professional and financial services the way large occupiers are a little bit. And they give you a little bit more leasing optionality and flexibility. So we can manage our expiry profile more consistently rather than risk having 30% of a building vacate in one hit from a larger occupier.
Right, got it. So let's put this all together then. Why is the trend that we've been talking about important for investors, and what do they need to know when you consider opportunities like the ones you're presenting?
Well, ultimately, work from home is the big trend, and its impact on demand. So what's really important, real estate, largely a function of supply versus demand. So you really need to understand, have those work from home space impacts been priced in? If space is yet to be handed back, how easily and effectively can you release that space back to the market? And really understanding that requires deep knowledge of the asset, the micro location, the leasing market, and how well that asset stands in a time of evolving occupier needs.
Right, Colin Mackay of Cromwell Property Group, thank you very much, and thank you for watching. If you want to see more episodes of The Pitch, you can go to livewiremarkets.com and our YouTube channel. Thanks for watching.